when we say, gold is up. What we're talking about the dollar price of gold, and I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. The euro is now $1.17. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar.
I think we've now formed a very solid base, really between about 1,200 and 1,500, which is where gold was trading for most of those years since it peaked. And now I think we've broken out of that range. I think we've taken out the highs. I think it's another leg of the bull market. I don't think there's going to be any significant pullbacks from here. I mean, there'll be pullbacks, but I don't think they're going to be very significant. I think if you're waiting for a big drop to buy gold, you're going to wait a long time. And when you finally get it, I think it's going to drop from a much higher price than it is if you just bought it right now.
Yeah, I agree with that. When I was talking about retracement, we had it. The retracement's over. I'm not forecasting retracement. Quite the opposite. I think it goes a lot higher from here. My point was that we had the retracement between 2011 and 2015. That's done. Now it's just onward and upward.
Yeah, the thing about Jimmy Rogers, though, I ran into him at many conferences, and he was waiting for a retest. I mean, Jim was waiting for gold to go to 1,000, and then he was going to buy more. I kept saying, Jim, it doesn't make sense. It's too risky to wait for 1,000 because it may never come. And of course, it never came. And then there were a lot of people who were waiting, for 1,200 when it was at 1,500. I mean, the world is going to be full of people who are waiting to buy gold and who are broke because they didn't just bite the bullet and buy it. Well, remember, too, the only reason that gold stopped rising at 1,900 was because the world was convinced that the Fed could unwind the policy, that it could normalize rates, that it could shrink its balance sheet. Had the market not believed that, then gold would have kept rising. Well, what's going to stop gold this time? They can't let rates go up because we're too broke to afford it. They're not going to be able to bluff that they're going to raise rates in the future because no one's going to believe that. They're not going to be able to pretend they can shrink the balance sheet because if they couldn't shrink it when it was $4.5 trillion, how are they going to shrink it when it's 10 trillion or 20 trillion? Who knows where it's going? So I don't really see how there's any way that they can stop. It's going to be the world severing its ties to the dollar. The world is going to go off the dollar standard and back on the gold standard. And I think that this is going to be a more precipitous drop in the dollar's value than it was in the 70s. And so we can see something equally as impressive in the price of gold.
There's a lot of analysis behind it. I don't just pull a big number out of the air and for publicity because I could care less. But if you just took the average, there are a couple ways to think about it, but there are other ways to think about it. Now, going to Peter's point, I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And interestingly, they come out in the same place. I don't think they have to. They're two different methods. But one thing people forget, David, is that they look at the dollar price in absolute dollars. So it went up $100 an ounce, or I expect before long it'll go up $1,000 an ounce a week. But the percentage increase gets smaller and smaller as the absolute dollar amount gets larger and larger. So $15,000 sounds like a big number from today's perspective, but as you go to 10, 11, 12, it gets to be a progressively smaller percentage increase, and therefore more likely. You need to see it logarithmically to see it on a more, the percentage increase gets to be pretty small at those levels.
To prevent that stock market bubble from deflating, it's possible that an ounce of gold and the Dow, the key is that they're the same price at some point, not necessarily what that price is, but that they're the same.
Peter's right. Could it be 25,000, 40,000? Maybe just take my monetary equivalent. If you use M2 at 100% backing, you get to 50,000 an ounce in a heartbeat. So Peter's right. My numbers, I think, are conservative. They could be much higher.
The whole idea that you could print all this money and not have inflation, the printing money is inflation. So by definition, you're creating inflation, so you have it. Now, obviously, there are situations where you can create inflation and it may manifest itself in rising asset prices before it ultimately moves into rising goods prices. And if you have a very productive economy that is generating more output of goods, then maybe you can create a lot of inflation without the price of goods going up because you're merely preventing the price of goods from falling, which would have otherwise benefited the citizens, because they would have been able to buy more for less. But at the end of the day, what they're advocating is not a free lunch, right? You can't have government for free simply because you print the money to pay for it. In fact, the most expensive way to finance government is through inflation, is through printing money. It's much better to do it through legitimate taxation, but of course, the public will resist taxes, especially when they're already broke, like most Americans are. But this is a panacea for government. They can pretend that they can have this laundry list of socialist programs. I mean, look at what we're doing now. All the bailouts, all the enhanced unemployment benefits, the PPP, right? Everybody is getting bailed out and nobody is getting a bill. Nobody's taxes are being raised. Everything is being paid for by the Fed because we think it's all free because everybody believes in MMT, whether they want to acknowledge it or not. But we're about to see that it's going to be a complete disaster because the dollar is going to collapse. And then, of course, what the MMTers don't get is, well, what do you do? What happens when inflation goes out of control? What happens when prices really start to go up? How do you stop it? Once you've let that genie out of the bottle, how do you put it back in? It's impossible.
Fed is trying to get out of this. They're trying to normalize the balance sheet, trying to normalize interest rates. Normalization meaning they'd love to get rates to around 3.5%, 4%, and they'd love to get the balance sheet down to maybe $2 trillion. So they could prepare for the next recession. They weren't forecasting a recession, but they knew one would come eventually. And it takes about 4 to 5 percentage points, 400, let's say, basis points of rate cuts to get the U.S. out of a recession. How do you cut interest rates 4% if you're at 1? Well, the answer is you can't. And that's why they came up with quantitative easing. So the effort was get to 4% rates, $2 trillion balance sheet, and you're ready for the next recession. That's what they were doing. That's what made Fed forecasting the Fed child's play. It was very easy. But I also said they won't be able to do it. They will not be able to prepare for the next recession without causing the recession that they're trying to prepare for.